Welcome back to the Deep Dive. Today, we are strapping ourselves in for, well, what I can only really describe as the engine room of a modern multi-trillion-dollar economy.
That's a great way to put it. It really is.
We are decoding the foundational architecture of the modern Indian payment system, the engine that processes transactions at a scale that few other nations can really claim.
Right.
We are talking about the National Payment Corporation of India, or Npci, and its flagship product, the Unified Payments Interface, UPI.
And it's so much more than just an engine. I mean, it's a piece of national critical infrastructure. Its success is reshaping not just how people buy things, but how governments deliver services, how credit is accessed, and even how international trade is settled.
It's huge.
It is. For anyone listening, if you think this is simply about convenience, you're about to see just how deeply integrated this system is into, well, governance and even geopolitical strategy.
So what's our mission today?
Our mission is to take this stack of really complex sources, regulation, tech white papers, financial data, and turn it into a clear, navigable map for you.
And we're going to start with a truly brilliant analogy from the source material, because talking about payment layers, it can feel a little overwhelming.
It can.
To simplify, let's think about building a modern website.
Precisely. You have to start with the foundational code. If you think about the basic language that tells a browser how to display text and images, that's HTML.
Okay.
That's your basic money transfer system. In India, those are the high-value systems, the older plumbing. Yeah. You've got EFT, Rtgs, and IMPS. They are the underlying code for moving funds between banks.
Right. But nobody today builds a really complex modern media site like, say, the Indian Express or a huge e-commerce platform using just raw HTML. It's too slow, too rigid.
Exactly.
I use a standardized tool, maybe content management system like WordPress, that just speeds everything up and provides a ton of features.
And that's where UPI sits in this hierarchy. If HTML is the basic code to write a transfer instruction,
then UPI is the platform or the interface that allows developers to easily and quickly build a consumer-facing payment app on top of that code. It just abstracts all that complexity away.
So we've got the underlying code, that's your NFT and RTGS, and we have the platform, which is UPI, and the final product.
Well, just like a big company uses WordPress to build their specific website, developers use the UPI platform to build the specific apps we all use every day.
BHIM, Access Pay, Google Pay, PhonePe, all of them.
All of them. That structural understanding is just vital. We are analyzing the operating system, the API layer, upon which thousands of applications are now running.
And to really get the scale and the mission, we have to start with the entity that engineered this entire thing, the Npci. Okay, let's unpack this. The National Payment Corporation of India, Npci. The structure itself is pretty unique. It's often called a utility, but it isn't a government ministry, and it's not, a purely private, profit-driven tech giant. So, what is it? It's a deliberate hybrid. It's designed to balance market efficiency with a public mandate. So Npci is registered as a not-for-profit company under Section 8 of the Companies Act of 2008.
A not-for-profit.
Exactly. And that legal status means that while it operates with corporate efficiency and financial discipline, its mandate is explicitly not profit-driven. Any surplus has to be reinvested back into the system, not paid out as dividends.
And that immediately separates it from, say, global players like Visa or MasterCard, whose main job is to make money for their shareholders.
Right. Their obligation is to shareholders. Npci's obligation is to the ecosystem.
Who were the original stakeholders then? Who was driving this?
Well, when it was first conceptualized, it was purely a banking initiative. It was founded by 10 major banks, both public sector giants and large private banks.
So that old quiz question, that Npci is owned by banks, that's true.
That is true. But the source material highlights a really crucial evolution in 2020. To make sure the entity stayed at the cutting edge and had enough capital, the ownership base was expanded.
And who did they bring in?
They brought in the ecosystem players, the tech front runners who use the platform every single day. We're talking about companies like Paytm, PhonePe, Amazon Pay.
Okay.
The goal was to align the interests of the builders, which is Npci, with the users, the fintechs, and the regulated entities, the banks. It became a truly collaborative effort.
And this collaborative public good mission, that directly informs their objectives. It's not just about making payments faster.
Oh, absolutely not. The foundational objective is financial inclusion. They are mandated to develop systems that are low cost, incredibly reliable, and accessible.
So that's the design constraint that leads to things like,
That's the design constraint that gave us innovations like UPI 123 Pay for feature phones. The mission is specifically to reach the unbanked, the poor, and the villagers who are often left out of the formal banking channels.
now we need to clear up a persistent piece of confusion that, it even shows up on major government exams.
I know the what.
And that's clarifying the ownership line between Npci and the Reserve Bank of India, the RBI.
This is a fundamental point. A lot of people assume NPCI controls all of India's payment rails. We have to confirm. The major interbank transfer systems, Rtgs and Neft, are not NPCI systems.
They're run by the central bank.
They are the domain of the central bank. The RBI owns and operates them directly.
Okay.
So Rtgs, which is for high-value transfers, and Nft for batch transfers, they are exclusively owned and operated by the RBI. NPCI's domain is the retail, instant, interbank stuff.
And that speed, as we said in our analogy, comes from the system it sits on, which is IMPS.
Yes. If UPI is the nice interface, IMPS is the infrastructure that provides the instant part.
Tell us a bit more about IMPS.
So IMPS is the immediate payment service. It's the core 24/7/365 infrastructure that allows funds to move between bank accounts instantaneously. UPI just leverages IMPS for its settlement process.
So IMPS is like the high-speed rail track that's always open.
Perfect analogy. And UPI is just the ticketing platform that makes using that high-speed rail simple for everyone. The moment you press send on a UPI app, that request is routed through UPI to IMPS for immediate settlement. That's what guarantees it's instant.
This layering brings us to a crucial element that most consumers probably don't think about. The plumbing that sends the instructions, not the money itself.
The financial messaging system.
Exactly.
These are highly specialized, very secure networks. They don't move the funds. They tell the banks what funds to move and where. Globally, the big power player here is SWIFT.
SWIFT, the international standard. What makes it so powerful in, say, a geopolitical context?
Well, SWIFT acts as the world's most trusted encrypted financial email system. Nearly every major bank in the world is connected to it, and the source material really emphasizes its political significance.
Right, like with Russia.
Exactly. When Russia invaded Ukraine, the decision to ban key Russian banks from SWIFT was a crippling economic move, in some ways much more damaging than freezing assets.
How does just removing the messaging system cripple trade? The banks still exist, the money is still there.
Because without SWIFT, banks can't send or receive standardized, secure payment instructions for cross-border transactions. If a Russian oil seller wants to get paid in dollars from a Chinese buyer, the Chinese bank has no secure way to tell the Russian bank, we've authorized this payment.
So they're cut off.
They're forced back to slow, high-cost methods like fax or email. It makes large-scale international trade practically impossible overnight. It just freezes them out.
Given that powerful global control, does India use SWIFT for its own domestic transfers, for Neft and Rtgs?
No, and this is key. India maintains sovereignty over its domestic messaging. Domestically, India uses the SFMS, or Structured Financial Messaging System.
SFMS.
It's India's own secure domestic messaging backbone. Every instruction for a Neft or an Rtgs transfer travels over SFMS between Indian banks.
And that keeps India's internal high-value transfers from being vulnerable to geopolitical risk.
Precisely. Or surveillance from external powers. It's a strategic choice.
Okay, so with that foundation clearly laid, Npci owning UPI on top of IMPS, let's dive into the practical consumer experience of UPI. What are the key features that drove its just monumental adoption?
Well, the biggest killer feature is eliminating the need for a separate wallet. UPI links directly to your existing bank account.
Right, through your VPA, the virtual payment address.
Exactly. This means money is never stored in some closed-loop system. It stays in your bank account, earning interest. That builds a lot of trust, and it's just more convenient. And then, of course, there's the ubiquity of QR code scanning. That made everything lightning fast.
And its reach is now pushing beyond India's borders, which must simplify things for Indian travelers.
That's the UPI at global push. Npci has formed partnerships, so Indian users can use their existing UPI apps to pay in local currencies in countries like Bhutan, Nepal, Singapore, and more recently, even in places like France.
Wow.
It's a massive convenience shift. You don't need to carry as much cash or rely so heavily on international card networks when you travel.
Now, you mentioned UPI supports two main transaction types, push and pull. Let's talk about the security of the pull mechanism.
A push transaction, where you send money, is pretty easy to understand. It requires your PIN, it's always discretionary, the risk is relatively low.
But a pull transaction is a continuous authorization. So if I authorize my utility company to auto-deduct my electricity bill, what stops them from pulling 10 times the amount?
That's the crucial regulatory challenge of pull. When you authorize a pull, you grant a mandate, but UPI mandates are regulated to be highly specific and, importantly, revocable.
How so?
First, the user has to explicitly set a maximum limit for the mandate. And second, the system has to offer a streamlined way to handle disputes. If a wrong deduction is attempted, you need to be able to instantly stop that mandate right from your UPI app.
So it puts the control back in the user's hands.
Much more so than traditional banking channels. It's often just a click or two on your phone.
Moving on to more advanced features, let's talk about delegated payments. This feels like a really smart way to manage access for, say, family members.
It's all about financial delegation and risk control. A delegated payment lets the main account holder, a parent for example, create a UPI handle for a dependent, like a child.
And that account is linked back to the parent's bank account.
Exactly. The secondary user gets a working VPA and can make payments, but it's all coming from the primary user's account.
And the key benefit here is control.
Absolutely. The primary user can set specific spending limits, so the dependent gets digital payment autonomy, they can use QR codes and so on, but the parent retains oversight and makes sure the spending stays within a predefined budget. It's empowerment with guardrails.
And these guardrails are mirrored across the whole system with structured transaction limits, which vary quite a bit.
Right. The limits reflect the assessed risk. The standard everyday limit for normal transactions, friend-to-friend general shopping, is 1 lakh rupees per day.
But they increase for certain things.
They do. They increase for transactions that are generally easier to trace and relate to long-term commitments. So for things like capital markets, paying EMIs, or buying insurance, the daily limit is doubled to 2 lakhs.
Because they're larger, but also lower risk for fraud?
Exactly. They're highly documented. And then the highest threshold is reserved for critical, high-value payments.
Right.
Things like medical and educational fees, participating in an IPO, or trading in government securities. For those, the limit jumps to 5 lakhs per day. And importantly, the limit for the feature phone system, UPI 1233 Pay, was recently raised to 10,000 rupees to better serve those users.
Now we get to the variants designed to defeat the enemy of any digital system: bad connectivity. Standard UPI needs a good internet connection. What does UPI Lite solve?
UPI Lite is the solution for reliability and speed when you have spotty connectivity or server overload. It works as an on-device wallet.
So you load money onto your phone first.
Yes. You proactively move funds up to 5,000 rupees from your main bank account onto this local wallet on your device.
And that gives you a couple of benefits.
2 core benefits. First, speed. Transactions under 1,000 rupees don't require a UPI PIN. This dramatically speeds up quick purchases. Second, reliability. Even if the bank's core server is temporarily down, the transaction can still go through because the debit has already happened.
But, and this is a vital distinction, UPI Lite still needs an internet connection, right?
It does. It still needs a data signal. To tackle the truly disconnected user, where there is zero internet, Npci introduced UPI LiteX.
LiteX is the true offline solution. How on earth does it work without any connection?
LiteX is a revolutionary system that uses NFC, near-field communication. It's the same tap-to-pay tech using contactless cards. The transaction doesn't rely on sending data over 4G or Wi-Fi.
So the two devices talk directly to each other.
Over a very short radio range, yes. Your phone and the merchant's device.
But how is it secure? How does the bank know I have the money?
The security is managed through locally stored encrypted digital signatures and tokens on both devices. When you tap, the transaction is cryptographically signed and stored locally on both devices. It's essentially marked as pending settlement against your LiteX balance.
And the actual settlement happens later?
Yes, when either the seller or the buyer reconnects to the internet. The data is then transferred to the bank, and the final clearing happens. The regulation says this has to happen within a short window, about 4 days, to update everyone's balances.
This sounds perfect for places like underground metros or remote villages.
Exactly where it's targeted.
Okay, one last feature. Conversational payments. This is about accessibility.
This is a huge step for inclusivity. It recognizes that not everyone is comfortable with a typical touchscreen app. Conversational payments integrate UPI with advanced AI. So instead of tapping and typing, you just talk to an AI assistant.
So I could just say to my phone, pay my friend 500 rupees for dinner.
Exactly. The AI processes that natural language, confirms the details, and executes the payment after voice or biometric confirmation. This massively enhances accessibility, especially for visually impaired users.
It's really astonishing how many versions of instant payment have been engineered. But let's shift focus to what might be the real heavy lifting for governance and poverty alleviation, the UPI overdraft facility.
This is, I think, perhaps the most profound systemic change. It links the payment rail directly to unsecured credit. The RBI now allows banks to offer pre-sanctioned credit lines, digital overdrafts, and link them to a user's UPI ID.
So UPI is no longer just a debit system. It's a credit system now, too.
Absolutely. A user, even with a zero bank balance, can walk into a store, scan a QR code, and pay. The amount is instantly drawn from that pre-sanctioned credit line. It's an immediate, ubiquitous form of buy now, pay later.
The implication for financial inclusion, especially in rural areas, seems huge. But what about the risk? This is unsecured lending.
That's the critical regulatory guardrail. The RBI knows this is a high-risk area. First, these are pre-sanctioned, not blank checks. They're based on the user's banking history, using sophisticated data analytics. Second, the RBI has mandated strict limits on the size and term of these credit lines.
So they're more like small emergency funds.
Exactly. The benefit is transformative for a poor villager. They no longer need to travel miles to a bank to apply for a small, formal loan.
Or go to a local moneylender.
And rely on those often exploitative, high-interest local moneylenders? No. This facility provides a secure, regulated, immediate source of liquidity right when they need it.
Next up, ERUPI.
Yeah.
This is the system designed to solve that age-old problem of government expenditure leakage.
ERUPI is often misunderstood. It's not a cryptocurrency or a digital currency. It's a prepaid, purpose-specific e-voucher.
Okay.
It's delivered to a beneficiary's phone as an SMS string or a QR code. The genius of it is its technological inflexibility.
Let's use the fertilizer subsidy example to show how it stops that leakage.
Okay, so under the old system, if the government sent a farmer 1,000 rupees for fertilizer, that cash could be spent on anything. With ERUPI, the government issues a 1,000 rupee e-voucher specifically coded for fertilizer purchase.
What happens if the farmer tries to use it at, say, liquor store?
When the farmer presents that QR code, the merchant's machine verifies the voucher's code against the merchant's category code. If the merchant is coded as alcohol and the voucher is coded fertilizer, the transaction fails instantly. It's technically impossible.
It ensures 100% targeting.
Exactly. It eliminates the massive leakage we used to see in social schemes.
And the scope for this is expanding beyond just government transfers.
Yes, the 2023 expansion was key. Now, individuals can buy them, so you could buy an e-voucher for your child specifically for a textbook. And crucially, non-bank PPI providers like Amazon Pay can now issue them, which dramatically increases access.
Finally, in this section, let's talk about how massive government payments, like for MGN Rtgs workers, are handled. The shift from bank account numbers and ACH to Aadhaar numbers, ABPS.
This is governance at scale. The older system, NACH, relied on the ministry sending the salary to the worker's specific bank account number. The problem there is data maintenance. Accounts change, they get linked incorrectly.
Or you have ghost beneficiaries.
You have ghost beneficiaries. The ABPS system aims to solve this by using the singular national ID.
Aadhaar.
Right. The ABPS, or Aadhaar Payment Bridge System, uses the worker's unique Aadhaar number as the key. The ministry sends the money to the Aadhaar number, and the system automatically links that transfer to whichever bank account the worker has designated as their primary one for subsidies.
And the government favors this because it's a deduplication tool.
It's the ultimate deduplication tool. One Aadhaar number can only be linked to one bank account for subsidy receipt. So it minimizes the chance of ghost beneficiaries or a single person fraudulently claiming multiple payouts.
But a source indicates this shift isn't complete yet. They're still using a hybrid approach. Why?
The sheer complexity of it. Moving millions of accounts across massive databases is the hurdle. So currently, the government uses a mixed hybrid mode. While the goal is 100% ABPS, they're struggling with technical issues. Failures in the APIs that link the databases, or issues when workers change banks without updating their Aadhaar linking.
So they're moving cautiously.
A very cautious transition to avoid payroll disruption for millions of vulnerable workers.
Okay, Npci's reach also extends into the physical world of ATMs and plastic cards. Let's start with ATM security and the incredibly smart solution of interoperable cardless cash withdrawal, or ICCW.
ICCW is NPCI's way of future-proofing cash withdrawal against physical fraud. It lets you withdraw cash from any ATM that supports the service just using your UPI app. No physical card needed at all.
Walk me through the process. How is it safer?
Well, when you select ICCW at the ATM, the machine displays a dynamic one-time QR code. You scan that QR code with your UPI app, say PhonePe. Then on your phone, you confirm the amount and authorize it with your secure UPI PIN. The instruction goes back to the ATM and the cash comes out.
So the security advantage is immediate.
It's total. Since your physical card is never inserted, you are completely immune to the two biggest threats: card cloning and skimming.
Because there's nothing for the criminals to read.
Nothing. It eliminates that vulnerability entirely. And you enter the PIN on your own phone, not the public keypad, so no shoulder surfing either.
Now let's look at NPCI's official app, BHIM, and why it's still so crucial even with the big private acts dominating.
BHIM, launched in 2016, is NPCI's own app. Its enduring relevance is its commitment to the lowest common denominator of hardware. BHIM is engineered to work not just on smartphones, but also on basic feature phones, using the 99.9 tag USSD service.
How does that USSD service actually work for someone without a data plan?
USSD is a text-based, menu-driven service that works over the traditional cellular network, kind of like an encrypted SMS session. A user dials 99 tag and gets a series of menus to check their balance or send money.
It's slower, I imagine.
Oh, it's slow and cumbersome compared to a smartphone app, but it is reliable, it's free of data costs, and it provides full digital access to millions who can't afford mobile internet.
Moving to plastic money, we have to talk about the rise of RuPay, India's domestic card network.
RuPay is a major strategic initiative. It positions India with its own sovereign payment network, competing directly with Visa and MasterCard. The benefit is threefold: security through data localization, faster domestic innovation, and, of course, cost control.
So what's the financial incentive for banks and merchants to use RuPay over the foreign networks?
Cost. That's the primary differentiator. RuPay was designed to operate with significantly lower transaction fees, or MDR, than the foreign card networks. This, in theory, lowers the cost for merchants to accept digital payments.
And it's accepted internationally now, too.
Yes, through partnerships with networks like Discover, RuPay cards are accepted in Japan, Singapore, and other places.
Since we're on cards, let's just quickly run through the 4 distinct types of plastic money in the ecosystem.
Sure. First, the debit card. Simple. Funds are pulled directly from your savings account. If the money's not there, the transaction fails. Second, the credit card. You're borrowing money from the bank, which you repay later.
And the newer types.
The third is the hybrid or duo card. That's one physical card with 2 chips, one for credit, one for debit. You choose at the terminal. And finally, the prepaid card.
Right.
The key thing here is that it's not linked to a formal bank account. You load it with cash and use it until the balance is gone. This is a critical financial inclusion tool for people without a formal banking relationship.
And finally, in this segment, NPCI's vision for mobility, the One Nation, One Card initiative.
That's the NCMC, the National Common Mobility Card. The vision is to eliminate the need for different cards or tokens for every mode of transport. NCMC is designed to be a single, interoperable card for everything: metro, bus, tolls, parking, even retail.
And FASTag has already revolutionized highway tolling using NPCI's tech.
Yes, FASTag uses RFID tags on the vehicle's windshield. As you pass through a toll plaza, a radio signal reads the tag, debits your account, and the barrier lifts automatically.
No stopping.
No stopping. And this all uses NPCI's underlying platform, the Nft. The benefit isn't just convenience, it's massive fuel and time savings by getting rid of those highway bottlenecks.
We've covered the mechanics and the physical infrastructure. Now we get to the thorny issues. How the RBI is mandating security, and the controversial economics of how to pay for all this. Let's start with a major security directive, tokenization.
Tokenization addresses what was arguably the biggest systemic vulnerability in e-commerce. Before this, when you saved your card details on a merchant site like Netflix or Swiggy,
You were taking a big risk.
a huge risk. If that merchant server was hacked, your real card details were stolen and could be used anywhere.
And the solution had to protect the data without killing the convenience of one-click checkout.
Exactly. Tokenization is the process of replacing your actual card details with a unique randomized number string called a token. This token is generated by the card network, like RuPay or Visa, and stored in a highly secured token vault.
And the key to its security is its limited utility.
Crucially, this token is useless if stolen. It's intrinsically linked to two things: the specific device, like your phone, and the specific merchant, like Amazon. If a hacker steals that token from Amazon, they can't use it on Swiggy because the token is coded to only work on Amazon's gateway.
It protects the user's real card details completely.
It makes a merchant data breach almost irrelevant for the consumer's card security.
Another key regulatory move aimed at empowering the consumer is the RBI's mandate on card portability.
This is a powerful new mandate. Until now, when a bank issued you a card, they dictated the network, usually Visa or MasterCard. The new RBI order gives customers the explicit choice to select their card network when they apply for a card.
RuPay, Visa, MasterCard, your choice, and you can switch later.
Yes, the order says they must be allowed to port their network, just like porting your mobile number if they want to switch from, say, Visa to RuPay. This forces competition among the networks to offer better services to the consumer.
Now let's dive into the economic heart of this revolution, the merchant discount rate, or MDR. We need to be really clear on what this is and why the government's intervention was so controversial.
Okay, so MDR is the core fee that funds the entire card ecosystem. It is the percentage of the transaction value that the merchant pays to their bank every time a customer uses a card.
So if the MDR is 2%, a 1,000 rupee purchase means the merchant only gets 980 rupees.
Correct. And that 2% is then split. A share goes to the issuer bank, a share to the acquirer bank, and a share to the payment gateway or card network like RuPay or Visa. This split funds everything: fraud monitoring, infrastructure, innovation.
Then the government's decision to mandate zero MDR on UPI and RuPay debit cards completely upended this model.
The goal was laudable: accelerate adoption by making digital payments free for merchants. But the effect on the financial viability of the system was disastrous.
If MDR is zero, the banks and RuPay earn no revenue.
Nothing.
Yep.
Which created the zero MDR problem. It's a massive disincentive for banks to promote the very systems the government wanted to push.
Why would a bank invest millions in UPI infrastructure if the income from it is zero?
They wouldn't. Their financial incentive shifts entirely to promoting fee-earning products like credit cards or foreign network debit cards. The banks were basically bearing the operational cost for a national utility without any compensation.
The fix was the government stepping in with a subsidy. How does that work?
Well, the government, through the Ministry of Electronics and IT, decided to compensate banks directly for their losses. They provide an annual subsidy based on the volume of UPI and RuPay debit card transactions each bank processes.
So it's taxpayer money covering the operational costs.
Essentially, yes. But the RBI governor has publicly stated this model is unsustainable.
What's the central bank's stance?
The RBI stance is one of long-term economic realism. The governor has made it clear that this reliance on indefinite taxpayer subsidies is not financially sustainable for a system of this scale.
So they believe a fee is necessary.
The RBI believes that some small, viable fee must be introduced in the future to keep the system self-sufficient and incentivized to innovate, rather than relying on the whims of government budgets.
To make sure the infrastructure build-out continues, the RBI also manages the Payments Infrastructure Development Fund, or PIDF.
The PIDF is the RBI's proactive intervention fund. Its purpose is to overcome the resistance of small merchants to adopt digital payments. The fund provides direct subsidies for deploying infrastructure like POS terminals and QR code systems.
And this fund is highly targeted.
Absolutely. The PIDF focuses exclusively on bringing infrastructure to Tier 3 cities and beyond, villages, small towns, and specifically the northeastern states. It's all about bridging that urban-rural acceptance divide.
Finally, let's touch on ensuring cash access remains available through different models of ATM ownership.
Right. The simplest is the bank label ATM, owned and operated by the bank itself. Then you have the brown label ATM, where the bank owns the machine but outsources the day-to-day operations.
And the most flexible model for remote areas.
That's the white label ATM, or WLA. This ATM is owned and operated entirely by a non-bank company, like Tata. They earn revenue through interchange fees. This model is crucial because these companies can set up machines in remote locations where a traditional bank might not justify the cost.
And at the most granular level, the micro ATM.
A micro ATM is basically a handheld device carried by a bank mitra or a bank correspondent. They bring basic banking services to the customer's doorstep using Aadhaar biometric authentication. It's deep financial inclusion where infrastructure is minimal.
For our final segment, let's look outward, how India is exporting its model and inward at the regulatory framework that keeps this whole thing running. Let's start with internationalization, beyond just tourists.
The long-term strategy is about currency autonomy and regional trade stability. The most potent move here is the Local Currency Settlement System, or LCSS, which India is setting up with key partners like the UAE.
How does the LCSS bypass the US dollar?
Historically, if an Indian company bought oil from a UAE company, the trade was settled in US dollars. Both sides had conversion fees and exposure to the dollar's volatility. Under LCSS, the agreement lets both parties pay and be paid in their local currencies, rupees and dirhams.
So the money never touches the dollar. What's NPCI's role in this?
Npci is the technological linkage. The LCSS is often enabled by linking India's UPI with the partner nation system, like the UAE's instant payment platform. This creates the tech rail for near-instant local currency settlement for trade.
This push for regional connectivity is also formalized in Project Nexus.
Right. Project Nexus is a multilateral project led by the Bank for International Settlements, the central bank for central banks. It aims to integrate fast payment systems across Asia.
So linking UPI with systems in Malaysia, the Philippines, Singapore.
Exactly. The goal is to create instant, reliable, and low-cost cross-border payments transfers that take under 60 seconds. This drastically lowers the cost of remittances for migrant workers and smooths regional trade.
And India is now exporting its technology, as we see with the J1 card.
The J1 card is the UAE's new domestic card network. And crucially, the UAE is building this network in collaboration with Npci, leveraging the core technology that underpins RuPay. This shows that India's payment stack is now a globally trusted, exportable platform.
Let's quickly circle back to SWIFT. We mentioned its geopolitical power. It's a messaging system, not a settlement system.
A key distinction. SWIFT is governed by global agreements, overseen by the G10 central banks. The ability to ban a country from it just confirms that even infrastructure that only sends instructions can be weaponized.
Which is why domestic control is so important to the RBI and Npci.
It's a matter of financial sovereignty.
Okay, finally, let's detail the regulatory environment itself. Who's in charge of licensing and managing disputes?
The whole thing is governed by the Payment and Settlement Systems Act of 2007. Under this act, any company operating a payment system is a payment system operator, or PSO. This includes card networks, wallet providers, everyone. And every PSO must get a formal license from the RBI.
And the specific body within the RBI that controls this is the BPSS.
The BPSS is the primary statutory body. It's responsible for regulating, supervising, and granting those PSO licenses, ensuring the stability and security of the whole system.
What about when a user has a failed transaction and the bank isn't helping? Where do they go?
That's the role of the DTO, the Digital Transactions Ombudsman. This is a senior RBI official who acts as a specialized redressal officer. A customer can approach the DTO, who can handle disputes up to 20 lakh rupees, providing a swift, high-level resolution.
One final major issue, the RBI's attempt to introduce competition to Npci's monopoly via the NUE.
The RBI recognized that Npci has, effectively, a monopoly. In 2020, they planned to issue licenses for a new umbrella entity, or NUE. This was meant to be a private, for-profit counterpart to Npci to foster competition.
So why is it on halt, even with interest from big players like Google and Amazon?
The process stalled because the RBI had serious reservations about the applications. There were concerns that allowing one or two massive private consortia to take over would just swap a public monopoly for a private one.
Concentrating risk.
Concentrating risk, potential data control issues. And the RBI was also reportedly not satisfied that the applicants had demonstrated the capital and governance structures needed to handle an infrastructure of this scale. The pause reflects a very cautious approach.
And a quick clarification on apps like Google Pay and PhonePe. They aren't banks, they're TPAPs.
Correct. Third-party application providers, they provide the user-friendly interface. But they can't settle money themselves. Every TPAP must partner with a partner bank access, ICICI, and so on, which handles the actual money settlement and regulatory compliance.
To measure the success of all these efforts, the RBI maintains two key metrics.
They use the DPI, the Digital Payments Index, to measure the adoption of digital payments. And they use the FII, the Financial Inclusion Index, which is a broader measure assessing overall access to formal financial services, banking, loans, insurance, to gauge the true impact. #outro.
It is genuinely astonishing to see the architectural breadth of Npci. It supports everything from a street vendor's QR code payment to multi-million-dollar international trade.
It really is.
We've seen an ecosystem engineered to solve India's unique challenges, from providing banking access on a simple feature phone with 99 tag to designing ERUPI to stop government fund leakage.
The impact here is about more than just efficiency. It's about technological equity. Whether it's the UPI overdraft facility providing credit to those who were excluded or tokenization protecting every online shopper, this stack is designed to democratize financial access. And its success was undeniably driven by the massive adoption under the zero MDR policy.
A success that comes with a price tag currently being paid by the taxpayer, a model the RBI says is unsustainable.
And that raises the defining economic challenge for the next decade of this payment revolution. As India seeks to maintain its status as a global leader in low-cost payments, what is the true hidden cost of instant zero-fee payments, and who will ultimately bear that cost?
If a small fee has to be implemented, should the convenience be paid for by the user, the merchant, or should the state continue to subsidize the utility?
That answer is going to determine if UPI remains globally dominant or if it faces a financial wall.